Your corporation, what you need to know if you don't understand your accountant. So let's talk about corporations today in basic terms. I find so many business owners, you start a business, but you don't really understand your accountant. And most of it's you don't need to know, but there's a few basic concepts you should really understand. I get asked these all the time, so let's just talk about them. So I'm coming to you this weekend from beautiful Niagara-on-the-Lake. So there's the lake. You see right across the river there. That is the American side. Those are our American brothers. It's actually Fort Niagara across there, where we mutually bombed our Fort George during the War of 1812. So Canada's really lucky to be right across the river from our American brothers. And both our countries are rich countries because we're capitalist countries. And as a general rule, the more capitalist a country is, the more comfortable all the citizens live. So now a really fundamental structure of capitalism is the corporation, and it's the limited liability you get from it. Okay, so it's really hard to start a business, arguably harder than getting a university degree. Only 5% of businesses actually survive the first year. So starting and building up a business is actually really hard. And the corporation allows us limited liability. You don't necessarily have to declare personal bankruptcy if it doesn't work. You've got your liability so limited to what's in the business. So corporations really encourage us to build businesses and, prosperity for all of us. So let's talk a little bit about corporations today and the basics that you need to know. All right, here's our topic for today: your corporation, what you need to know if you don't understand your accountant. So I'm a fee-for-service financial planner. I see the financial planning side, also a CPA tax accountant. So I understand both sides, and I'm going to try to explain this in real simple terms. So here's what we're going to learn today. We're going to learn the basics and these are the most common questions I'm asked by business owners. Should you incorporate or not? Should you have a holding company or just one corporation? Should you pay yourself salary or dividend? Once you have some profits, should you invest them in RRSP or TFSA in your corporation? What should you do? So now I just want a little disclaimer here that these are all complex topics, and what I'm going to give you today are just the general rules of thumb, the strategies that work most of the time, but there are all kinds of reasons why you may choose something else in certain specific situations. All right, but these are kind of the basics that will work in most cases. Okay, and most of our clients tend to be growth focused people, so this is more talking in that kind of language. So all right, so when should you incorporate? So I get asked that a lot. You start up a business, and now should you have a corporation or not? And there's basically three reasons why you would want to incorporate. And if these are true, any one of these are true, then you should seriously think about it. So, or at least get advice about it. One is if you risk being sued. Right? So if your business has a reasonable chance of being sued, you don't want to be sued personally for it. Corporation gives you some protection, not complete perfect protection, but it gives you reasonable protection because your customers are working with your corporation. If they have a problem, they can sue the corporation and what's in there, but not you personally. So another one is if your business can be sold. So this is actually an important concept, because to build up a value of a business and be able to sell it eventually is really cool. But selling it means that the business is not just you. If you have just a personal service business, it's just you, what you're doing. You can't sell that to anybody else. So you have to build the business up in a way that you can eventually leave and somebody can buy it and run the same business and make a profit. So if you think you can get there one day and have it be sold, then there is a tax-free capital gain on shares of a small business corporation. This year in 2022, it's up to $914,000 per person. So that's you and your spouse together could have almost $2 million tax-free. You could sell your business somewhere down the road for $2 million for tax-free if you can do all this right. Now, you may or may not sell it that way. However, just being able to have that option, if you think you can sell it, another reason why you should possibly incorporate. The third one is just if you have cash left in the business for your future. You're starting to save up, and usually it's not just a minor amount, it's a more significant amount, because there's a tax deferral that you can get by leaving your money in your corporation. Okay, so and once it's a reasonable amount, then it may be worth creating a corporation so that you can get that tax deferral and leave money in the corporation. I'll explain that in a minute. So now, first of all, incorporating is something you should need advice on. I know we had a client that went out and started a business. He just went out and set up his own corporation. And then I asked him a few basic questions, like, did you set up shares for your wife? Oh, I didn't think about that. Like, what classes of shares did you have? Oh, I didn't think about that. What's the year end that you chose for your corporation? Oh, I didn't think about that either. So and this is not and he's already, he's set it up for only $500. He set up his own corporation. However, now he's got the wrong corporation and he's got to go to a lawyer to get it fixed up. So that's actually worse. So before you do incorporate, like, it's possible to do it yourself, but it's the best thing to do is get a lawyer, get some advice, talk about the structure for it. Generally costs, say $1,000 to $2,000 to set up a corporation, then plus $1,000 to $2,000 a year. Most of that is the corporate tax return. So, and there are advantages. Like, for example, you could give your spouse, you could also have equal, ownership 50-50, or your spouse could have, class B non-voting shares, so that you could potentially pay some dividends to your spouse later on, a bit of income splitting. You could do that maybe with adult kids, not with kids under 18. So it's just basically, all I'm saying is, before you incorporate, get some advice and do it properly. Now, here are some real common mistakes that I find with business owners, just in thinking. And so I'm just mentioning these specifically because they're issues, especially for, people who are growth focused, trying to build up. One is the thinking that my business is retirement. I don't have to save anything because I'm just building this business. And the problem is, it's really hard to sell your business. It's you got to sell it without you. Lots of things could go wrong. So many businesses fall apart. And if you can't sell it at the end and you haven't saved anything else, then you're stuck. You've got nothing for retirement. And, I've seen people struggling with their own business, and they're in their 70s and they can't sell it and they can't shut it down and they haven't saved anything. So you get a real sense of confidence if you also build up your regular retirement investments just like other people do. And then that way, if your business works out well, it's a really good big bonus on top of it. But at least you're not desperate that you have to sell it, or you can't retire. So the other thing is, I find it's a weird thinking that I find quite a few business owners, when they have profits, they want to invest them conservatively. And the thinking is, I work really hard for my money, so I don't want to lose it. But you know what? Makes no sense at all. And here's what it is. You worked hard, so now your money can be lazy. No, your money needs to also work hard. So your extra money you also invest it, let it grow. And here's, from doing financial plans, I've written well over 1,000 financial plans. And here's what will shock you. If let's say you were saved for 30 years and then retire, 60, 65, and then live for another 30 years. And you've saved enough to be able to do that. So more than half of your retirement income is the growth of your investments after you retire. So it's like having investments that grow and continue to grow even after you retire is how you fund a comfortable retirement. So you got to get comfortable with having it grow, make your money work for you as well. And you believe in your business and the growth of your business. So you should also believe in investing in equities in the stock market and companies, because these are also businesses. So now, once you have your main company, it's called an operating company, should you also get a holding company. So this happens when you start to invest some extra money. Okay, so you could invest inside your corporation, or you can withdraw it, which I'll talk about in a minute. But if you're going to invest inside your corporation, you could invest in your main company or create a separate holding company just for the investments. So why would you want to do that? So remember, it's a separate cost to set up the corporation. It's now 2 corporate tax returns every year, so it's more complicated and more expensive. So, however, here's some reasons. So for one, you may have shareholders in your corporation, like partners, that aren't family. So you don't want to invest your personal savings in this corporation if some friend also owns half of it. So then you'd need a holding corporation. Another one is if there's significant risk of being sued in your main company. So you may have set up a company because there's a risk of being sued. Now you don't want to put all your life savings in there as well, because if they get sued, that can get taken. So that's why you put it in a separate company. So people can sue the operating company, and you don't have your life savings in there. So the third one is that you could potentially get this tax-free capital gain, and I'll explain this in a minute. But if you have your main company is full of investments, then you don't qualify for this huge tax-free capital gain. So those are the main three reasons why you might want to get a holding company. So, all right. And, once you get a holding company, you just think of it as your RSP. This is your retirement portfolio. This is where you're saving up. Now let's talk about this tax-free capital gain. It's kind of a cool thing. But actually, in actual fact, it's not actually used that often. So you get it if you sell your company, you sell shares of your company. You and your spouse could each do, you could do 1.8 million, 900,000 each. It's all tax-free, but people have to buy the shares of your company. Okay, so now a lot of times sales are done where they just buy all the assets of your company, or you buy your client list and your building and your assets and all that. And if they do that, you don't qualify for it. They have to buy the shares of the business, and there's tax advantages for you versus the buyer. Okay. However, it's you may or may not sell it this way, but it's really important to be able to qualify. So if you set it up so that you could do it, and it's actually, even when you sell, it's a good negotiating position to be. So it's important to be able to do that. Now, to be able to qualify, there are some complicated rules. I won't get into all of them. They relate to what was in the company in the last 2 years, and the last 5 years. But the basic thing is that 90% or more of the assets of the business, the value of them, has to be the operating assets, like part of the business. You can't have, and only 10% or less can be your investments. So if you got your big investment portfolio in there, then it won't qualify for this tax-free capital gain. So that's if that happens, then put your investments in a separate holding company, and then your main company could be sold to get this tax-free capital gain. So now, should you pay salary or dividend? You get this question all the time. And, as a financial planner, actually, I see this differently than a lot of accountants. And I can explain in a minute why. But first of all, you need to understand the difference is, first of all, the total tax that you pay isn't actually much different. So let me show you how this is. And it's called integration of corporate and personal tax. So if you pay yourself, let's say your company makes 100,000 salary, okay, and or it makes a profit of 100,000. So if you decide to pay yourself a salary, the company gets an expense for it. So the company has no profit, doesn't make doesn't pay any tax. Now you have a salary of 100,000, you pay tax at the personal tax rate for it. And it varies, but let's say you're paying 43%, you're in the 43% marginal tax bracket. So let's say you're paying 43% tax. This is more to give you the concept. Now, the other option is your company makes a profit of 100,000. Okay, now you pay yourself a dividend of 100,000. Now, a dividend, the company does not get a deduction, so the company pays tax, but they pay tax only at 12%. Okay, now you take this dividend out and you pay personal tax on that at 31%, and total tax is 43%. It's basically exactly the same tax. It's exactly or very close to the same tax total. Okay. So now the difference is this. Let's say that you make a profit, but you leave it in the company. What happens now is you pay this 12% tax, okay, but you defer the 31% tax. So that's a pretty low tax rate, and you leave that money in the company, and it's a deferral. Okay, so it's a different kind of deferral than RSP. RSP, you put money in, you get full savings of it, like a full refund based on it, but you have to pay full tax on it later on. So here you pay 12%, but the other 31%, or whatever tax rate it is when you take it out personally down the road, is this amount is deferred, and you could pay it many years from now. And it's one of the principles of tax is, deduct, defer, divide. So defer it. It's better to pay tax 20 or 30 years from now than now. And meanwhile, you can leave the money in your company, invest it, and let it grow. So really important tax deferral. And that's part of why paying dividend is actually much more useful when you're investing in your corporation. Talking about salary dividend, here's a few things we got to go through here. So first of all, the total tax is almost exactly the same. Now I give you a simple example, and depending on exactly the income level and whether it's higher amounts over 500,000, and there's slight differences to it. It's not always exactly the same, but as a general rule, there's a slight savings, about 1% to paying salary. Okay, so but that's a very small difference, and that shouldn't be your main factor in looking at it. All right, basically the integration isn't quite perfect, and the tax department's always trying to get that integration to be perfect. But every province has slightly different rates. So the biggest factor really in most cases is the Canada Pension Plan, not tax. The biggest factor in deciding on salary or dividend. And here's what it is, because if you pay yourself salary, you have to contribute CPP. To contribute to CPP, and because you're employer, you're also the employer. You have to pay double. The employees half and the employers half. You got to pay double CPP. So you don't pay EI because you can't collect it if you lay yourself off, but you pay double CPP. Now this year in 2022, it's 5.7%. Next year, it's going up to 5.95%. So you're actually paying, both sides. You're paying 11.9%. Say 12% of your income you have to pay into CPP. Now, CPP actually has a really low rate of return. If you pay in the maximum for 30 years and then retire, take a normal retirement for normal life expectancy and collect the maximum CPP, growing by inflation, what you find is you've actually only made 1.96% return on your investment. It's a crappy rate of return. It's like a savings account. Okay, so, and actually the way to look at it also is if you look at over your life, you put 7,000 into your CPP and how much you get for it. But if you, considering you have 40, 50, 60 years in front of you, if you put only $700 in a stock market investment, it could give you a similar amount income over your life. So the general rule of thumb is CPP, you only get about 1/10 the value. You get about 10 times the value by investing yourself in equities. Okay, so that part is a big thing. We think of it as a CPP is mostly an expense. It is a savings, but it is mostly an expense. So paying dividends only. One cool thing is if you pay yourself dividends only, you don't have to do a payroll. So if you pay yourself a salary, you got to do a salary. You have to deduct their CPP, right? And now you have to remit every month or every quarter. You have to do the tax. You can do a T4 at the end of the year and all that kind of stuff. So, but if you have a payroll, if you have dividends, you don't have to do a payroll at all. It's a big, huge admins saving. So now the other side to it though is that if you pay yourself dividend, you don't get more RSP room. So then you need to invest somewhere else, and that's why investing inside the corporation is usually the best choice here. So bottom line is the dividend is usually the best option if you're going to invest in your corporation. Now, if you're not going to invest in there, it might be different. And the CPP is a big factor, but possibly a bigger factor is you need to be able to save for your retirement somewhere. And if you pay yourself salary, then you get RSP room and you contribute to RSP every year. And that I find for a lot of business owners who don't have the discipline to invest inside your company, then getting RSP room and contributing it means you're saving. That might be a more important factor. But the optimal way to do it, the more tax efficient, the more efficient way to do it is to pay yourself dividend, only withdraw the amount that you need for your personal expenses, leave the rest of your money inside your corporation, make sure it's more than you would have otherwise put into RSP, or at least as much, and then invest it inside your corporation. So now, should you invest inside your corporation or in RSP or TFSA? Now, I'm going to do another video shortly on this topic. So this is another more involved topic, but I'm just going to give you the summary answer here. In most cases, the general rule of thumb is RSP is the most effective use of your money. In your corporation is second, and the TFSA is third. So RSP means you could take money out of it and the corporation put it in the RSP. And if you do that, you pay yourself an extra dividend. and then put it in RSP, you actually get a net tax savings, close to maybe about 7% or something of the amount that you put in. You actually get an overall tax savings. And, if you're investing in your corporation, you're going to pay some tax on the growth over the years. The money is in the RSP. You don't pay any tax at all until you take it out much later on. So generally RSP in most cases is a little bit more effective. Then corporation, you get, that extra 30% tax deferral. That's the most effective. And TFSA, you don't get any tax deferral, right? So remember, if you take it out of the corporation, you pay yourself a dividend, you have to pay personal tax on it. Then you can invest it personally. So you actually have less money to invest. So this is just the general rule of thumb. There's lots of reasons this may be different, but in most cases, those are the priorities. So, and again, watch my next video. You'll see much more details about this. So now you need a tax accountant. If you have a corporation, you need a tax accountant. So I can tell you, I am a tax accountant, CPA, and I have a business, in fact, 2 of them that are corporations, but I use a separate tax accountant to do my corporate tax return and give me advice on structures and things because it's really complicated. It's something you have to actually specialize in. So your tax accountant is a valuable source of advice and a valuable partner for your business. So, however, tax accountants have some biases, and you should understand these. And there's reasons why their advice isn't always the best for you. So first of all, tax accountants are usually not investors, and usually really conservative, right? If you've met a lot of accountants, they're really conservative investors. So, and their bias may be that way. So for example, they often think that CPP is a good investment, and they haven't really figured out that return is, 1.96, less than 2% a year is the rate of return on CPP. And they focus, you put the money in, it's a guarantee, from the government. So you should get the guarantee. But, I'd much rather invest it in equities over long term. I'm going to make, 8 or 10% as a long-term average, not 2%. So you'll find that your accountant very often recommends a mix of salary and dividend, and often say pay enough salary so that you can pay the maximum to CPP and the rest in a dividend. To me, that's exactly the reverse. I'm paying dividend so that I don't have to pay in CPP, right? So yes, and they're often going to focus on, there's that slight tax savings from paying salary, and you'll find that accounts will go through, I did all of it, and you save some tax by paying yourself salary, but it's a small amount. And meanwhile, you have to pay 12% of your income into CPP, so which is a way bigger factor. So this is where you may be getting advice that isn't necessarily optimal, and it's because your accountant isn't the investment person, doesn't see that side to it. So now your tax accountant doesn't do the investing, and they also don't do retirement planning and stuff. So you should have a tax accountant, but also a financial planner, and you kind of need both of them. So, and the best thing is if your financial planner and your accountant can talk. So, for our clients that are business owners, we give them our advice. The accountant gives them their advice, and much of the time it's the same advice when we're good to go. And if it's different, then what we do is I talk to their accountant directly. So we're talking accountant to accountant, and let's figure out what's best for you. So, and it's the worst thing in the world. Can you imagine this, that, your financial planner gives you some advice, and then your tax accountant gives you different advice. And these are your 2 experts, and they both know way more than you do. And somehow you're supposed to figure out which one to go with. That's not a good way to do it. It's better that the 2 of them talk, figure out what's best for you. And then that's what you should be able to do. That's the most effective way to do it. All right, so what we've learned today, we've learned kind of these basic terms and basic concepts that you need to know as a business owner. So I hope that this has all been helpful for you. Where we can help you is that we have my blog, Unconventional Wisdom, where we have this video. It's also on YouTube, and it'll be the next one, which will be more on investing inside the corporation. So, so you'll find that there's everything about us is on my blog. My blog is the #1 blog in Canada for a financial planner. So full of great information. And we've got the focus on the strategies tab, where we've got all these great strategies, the services tab, which tells us all of what we offer, all the services we do and what we charge. And if you want to talk to us, just hit the contact tab and ask for a free 30-minute consultation. Okay, thanks for listening today. And if you like this video, please like and share it. And, if you subscribe on my YouTube channel and also on my blog, I don't market to you ever at all. All that means is that you will get directly to your email any new articles or videos that I write or that I post. Thanks again for listening, and talk to you next week.